Hello everyone, this is Lisa Mayton. Thank you for joining me again for another installment here at SexyNet News. Today I would like to discuss the stock market and the continuing decline of the U.S. dollar. Right now, some of the best estimates puts the U.S. dollar spending value at 74 cents, a loss of 26 cents. If we make this a little easier and say the dollar spending value is at a 25% loss, making our dollar worth 75 cents, the increase you see at the pump, for instance, $4 a gallon is actually $3, and $5 a gallon is actually $3.75. You're paying 25% more than you should because the spending value of the dollar is less than it should be. This graph shows how the dollar has fluctuated in spending value over the last few years. If the government would quit playing with our world value of dollar by monetizing our debt, which, by the way, Bernanke promised he would never do, and to this day claims he never has. And yet the Fed owns 70% of our debt. If you add in QE1, QE2, it takes us back to why our dollar is only worth 75 cents. Here's Bernanke's recent testimony in front of Paul Ryan in the Economic Congressional Committee.
Thank you, Mr. Chairman. First, let me lead off with what you concluded. Just to summarize, you do believe that one of the best things we can do for short-term economic growth is to put out a plan that actually stabilizes our fiscal picture, that actually gets our liabilities under control and shows with confidence that we have a right trajectory because we've addressed the programs, which are our spending programs that are getting us out of control. Is that the case?
That's correct.
Okay. I want to talk to you about QE2. The last time you came to the committee to testify, you said that QE2 is not an exercise in monetizing the debt. Now, the question basically is this. I understand from your perspective you can say that QE2 is not monetizing the debt because it's not causing runaway inflation because the money you are creating is not yet circulating in the broader economy. It's being held as excess bank reserves. But isn't this sort of a distinction without a difference? It seems to me that the argument here is that the intention of QE2 is what we ought to be focusing on because the intention is to bring rates down, to promote economic growth, and therefore the intention is what should matter here. But this is debt monetization. So isn't that really a distinction without a difference?
No, sir. If monetization would involve a permanent increase in the money supply to basically pay the government's bills through money creation. What we're doing here is a temporary measure which will be reversed so that at the end of this process the money supply will be normalized, the amount of the Fed's balance sheet will be normalized, and there will be no permanent increase either in money outstanding in the Fed's balance sheet or in inflation.
So if we get this wrong and if credibility is diminished because of these moves and if expectations form around price increases, then we do have a big interest rate problem. And if you look through our fiscal side of it, just raising interest rates under normal average predictions would just be vicious to our balance sheet. The interest payments alone in the current budget window, which assumes extremely low interest rates for the decade, go from $200 billion this year to $1 trillion at the end of the budget window. If interest rates move up from their current projections, which I think long bonds are about 4 to 5% throughout the budget window, that's about 1 to anywhere from $6 trillion in extra interest payments. So basically this is all based on confidence that what you're doing and saying will actually be done. And confidence and credibility is just critical in all of this. What I'm trying to get at is, just take a look at today's Wall Street Journal. Inflation worries spread. You've got basically inflation jitters spread through emerging markets. In Brazil, Latin America's largest economy, the government reported Tuesday that inflation is accelerating. We've got inflation popping up in other parts of the world. After all, many countries peg their currencies to the U.S. dollar. And my basic question is, to what extent do you think the Fed's monetary policy stance has contributed to these global inflationary pressures? Has this contributed to the hot money flows abroad that have led to some of these global imbalances that are not fully appreciating when we examine the costs and benefits of your current QE2 monetary policy stance?
Mr. Chairman, your first sentence under the headline was very revealing. The inflation is taking place in emerging markets because that's where the growth is, that's where the demand is, and that's where, in some cases, the economies are overheating. It's the responsibility of the emerging markets to set their monetary and exchange rate policies in a way that will keep their economies on a stable path. The increases in oil prices, for example, are entirely due, according to the International Energy Agency, to increases in demand coming from emerging markets. They're not coming from the United States. So the bulk of the increase in commodity prices is a global phenomenon. In the United States, inflation made here in the U.S. is very, very low. Now, of course, that's a serious problem, but monetary policy can't do anything about, for example, bad weather in Russia or increases in demand for oil in Brazil and China. What we can do is try and get stable prices and growth here in the United States.
So as you look at some of the leading indicators, the yield curve, for instance, commodity prices, do those not send you a warning that inflation is building in America, or are you still looking at core inflation as your main guidepost to measuring whether or not monetary policy is keeping prices in check? My basic question is, my concern is, using your output gap model, my fear is you're going to catch it before the cow's out of the barn. You're going to see inflation after it's already been launched. And given that you have a huge balance sheet, given that we are basically in uncharted territory with respect to the Great Recession and the responses that you put out there, that we're going to catch this after it's too late. Could you please give us a sense of what else you're looking at to gauge inflation in America other than core inflation, which, as you know, there's a big debate as to whether or not that's the proper tool we use or not. Even the ECB uses broader definitions of inflation. So where are you looking outside of your core deflation to give you a gauge as to how to set monetary policy to prevent inflation from actually getting unhinged here in America?
Mr. Chairman, let me say first that there be no doubt that we are unwaveringly committed to maintaining price stability. That is a very, very strong goal and objective. We will do so. In terms of what we are looking at, first of all, overall inflation, including food and energy, is still very low, about 1%. But looking forward, you asked about credibility in the yield curve. If you look, for example, at inflation break-evens, which are a measure in the inflation index bond market of what the markets think inflation is going to be, the 5-year break-even is about 2%, 2.1% last I looked. So there is not really any indication in our financial markets that in the United States there's an expectation of inflation. That being said, we will look very carefully not only at output gaps and those things that you mentioned, but also at commodity prices, at interest rates, and all the other indicators that will help us assess when inflation is becoming a problem. It is always an issue, as you know, Mr. Chairman, that in the recovery period, you have to pick the right moment to begin removing accommodation and taking away the punch bowl. And we, of course, face that problem as the central bank always does, but we are committed to making sure that we do it at the right time.
So when you see the steepening of the yield curve that's taken place recently, do you see that as market participants showing some concerns about future inflation, or do you see that as signs that an economic recovery is beginning to take root?
The inflation break-evens have risen since we began the QE2 program in August, but they have moved from very low levels to about normal levels. The bulk of the increase in interest rates has been in the real side of the interest rate, which means that, like the stock market, the bond market is expecting greater future growth and is more optimistic about the U.S. economy. And I think that's a good thing, obviously, and I think our policies have contributed to that.
So we obviously have a bigger punch bowl than we normally have in these times, and if we were in a cyclical situation, I don't think concerns would be as great as they are right now, but I think part of our problem, as you mentioned on the fiscal policy side, is structural. We have a tidal wave of debt we're running into. Mm-hmm. If interest rates begin to leave the current projections, we have a serious problem on our hands, and it just gets to a vicious cycle, like you've described. The punch bowl, your asset, your balance sheets. Have you done a stress test on the Fed's balance sheet assets as an exit strategy occurs with higher interest rates that perhaps result from what's been going on? So have you done a stress test on your balance sheet, and what level of losses do you think are acceptable as you withdraw?
We have done multiple stress tests. Under most likely scenarios, the fiscal implications of the balance sheet are positive. And we've already turned in the last 2 years $125 billion to the Treasury, and given our low level of cost, our low cost of financing, under most plausible scenarios, will continue to be, this policy will continue to be profitable. Of course, that's not the main objective of it. The objective is to strengthen the economy. If short-term interest rates were to rise exceptionally high, much more than we anticipate, then it could be that the remittances to the Treasury would go down for a time. But in that case, it would probably also be the case that the economy was much stronger than expected and tax revenues would more than compensate for that loss. So our sense is that the net expectation from a fiscal side is that this will actually be constructive for and reduce the federal deficit.
Companies who trade globally can better accept and profit from the current devaluation of our dollar. Example, Coca-Cola in the U.S., people on average spend $1.50 a bottle, but in Europe, Coca-Cola sells in euros. These global prices are static, meaning they stay the same. For the businesses that trade on a global scale, the exchange rates can make them a much higher profit outside the U.S. to offset losses here in the U.S. This equation does not work too well for small businesses here in the U.S. that do not trade on a global scale. Now let's take a look at the stock market, which is artificially inflated. Numerous stock market professionals will tell you if the stock market was indeed rising on solid ground in value, commodities, precious metals, and oils would fall in price. But as you can see, they are all rising together. It is my opinion that with all the continuing investment in the safety net of oil, commodities, and precious metals, the only logical conclusion that I can draw from this is that when the artificial inflation stops, the stock market will come down. Not slowly, but rapidly. Here's a graph of the current stock market and what happened the last time gas prices reached this level, and how quickly it impacted our economy here in the U.S. My guesstimation on time frame for the coming events with the stock market will be the end of QE2, which will end in June 2011. But don't be surprised if it happens sooner. And God help us all if Bernanke implements a QE3. I am quite certain that many people, including high-ranking officials, already know how bad our economic future is and where it is headed. And I am sure they are already prepared. The big question here is, are you prepared? One sure sign that makes me believe they already know, well, the Fed now owns 22% of the world's gold under the Federal Reserve in their basement. The media wants you to believe, no, actually, they need you to believe that we're in an economic recovery. They want you to believe that unemployment claims are dropping. But in reality, every action has a reaction. And our government's actions are creating this devastating domino effect. Higher fuel prices leads to higher food prices, higher airline tickets. With each passing day, the U.S. businesses trying to stay afloat not only lose revenue, but soon they'll be laying off more people or just going out of business. So no, we're not in an economic recovery. No, unemployment is not dropping. I ask of you, my viewers, to do your research. Prepare your family. And I always say, prepare for the worst, and please, just hope for the best. More than anything, always be prepared. If you have any questions, comments, concerns, or stories you would like to share or see covered here at SexyNet News, you may email me at sexynetnews@gmail.com. Follow me on Twitter. Look me up on Facebook. I'd love to hear from you. And thanks so much for tuning in this evening. Good night, America.